Hi, it's Roberto, and this is another tutorial. I wanted to just go over this is another simple strategy, just using a couple of moving average lines. This is a 20 and an 8 exponential moving average line, stochastic syndicator, and price action. And we're going to be looking at several time frames to confirm a trade setup. So the first thing I do is look for a crossover on the 8 and 20 moving average line. Let me highlight that for you. Here's a crossover. This is where the 8 crosses the 20 moving average line, and that is a buy trigger on a daily chart. So if you're looking at a daily chart, and I'm waiting for that to happen again here on this pair. This is Australian Canadian dollar. And also, when you're looking at a chart, depending on the time frame, make sure you're looking at several sessions, or on a daily chart I'm looking at least 2 or 3 months. So I know where all the support and resistance levels are. For example, here we had very strong support level. Let me highlight it. So I'm thinking this is like a week of the market not wanting to penetrate this level. And look, if I look further back, there's a resistance that turned to support. So I know back in December 2014 there was a strong resistance. That resistance was broken, and then a month later, remember, price has memory, came back and bounced off that same level of resistance turned support. So I know this is a strong support level. So I'm feeling comfortable of looking to buy around this area, and then I look at stochastic syndicator and I see that it's overbought on the daily chart. So the combination of indicators, looking at price action, the 2 lines, the 8 and 20 exponential moving average lines, they all work together to create a situation where you can have a buy or a sell alert. Okay, so price is finding support. Here we have your candlestick patterns, spinning top, doji. Price breaks above the 8 moving average line, but it's bouncing off that 20. So I'm waiting for, I actually took a trade, but based on the smaller time frame. Stochastics oversold, so the stop loss would have to be down at this level, number 1. Okay, so if I'm going to have a stop loss, it needs to be below the support. Now let's look at a smaller time frame, 4-hour chart. Okay, let me make it smaller. Alright, we know that a support has been established here at 95, 90 area. Now on a 4-hour chart, notice the 2 lines, the 8 and 20 moving average lines, are crossing to the upside. So that's why I took the trade. Not only that, so let me just show you the many reasons why I took this trade. First, we had a bullish engulfing candle on a 4-hour chart. After, look how many candles, 1, 2, 3, 4, you know, there was about 10 small candles. Well, actually not 10, there's 1, 2, 3, 4, 5, 6, 7, about 6, 7 candles. And this one bullish candle completely engulfs all of these. So that is a buy signal. Okay, this candle right here, this bullish engulfing candle, is a buy alert with stochastics overbought. Now, if I go to the daily chart, this bullish engulfing candle in the 4-hour chart, and looking at stochastics oversold on the daily, that really helps me a lot. The only thing is I'm wanting for this price to break above the 20, so when it does, it should continue to the next resistance level, which is, which is actually not all the way up here, but down here. This is the next resistance right here. Okay, and usually I'd like to use the body as the resistance, not the wick. So I'm going to use the stop loss right there, which is quite a distance away. That's about 60 pips away. Okay, so again, looking at different time frames will support, one time frame will support another. For example, we saw the bearish engulfing candle, a bullish engulfing candle on a 4-hour chart, and stochastics oversold on daily. We had spinning top, doji, and then the next candle, we know when we have a series of dojis or spinning tops, and then we have price breaking above or below, then we know that's the next trade, and price broke above the spinning top, so we would be looking to buy. Okay, let's look at the 1-hour chart, and we had, on the 1-hour chart, we had quite a consolidation area here, and what happened? Price broke above this consolidation, so we're in an uptrend. So it's basically, this is a breakout trade. Okay, let me just remove all the indicators. So when you're looking at a chart, just make sure you find many reasons, and of course you're not going to know those reasons unless you know your candlestick patterns. You understand the crossover, the 8 and the 20 crossover, that when price breaks above the 20 and the 8, that we're in an uptrend, and that's what we are right now. Also the time of day, the beginning of the Asian session, which is generally around now. If you see the market take off in a direction in the Asian session, then that pretty much sets the tone for the day. And that's what's happening right now. The market was, for the past 3 days, it was not really going anywhere. It would take a direction and then it would pull back, take a direction, pull back, take a direction, then pull back. It didn't really go anywhere. It was just trending. Now it finally broke the resistance, right? That's why we use trend lines. It broke the resistance, and now we're in an uptrend. Okay, so daily chart, we have support, stochastics oversold, we have series of dojis and spinning tops. Price breaks above, that means that bulls are in control when price breaks above the spinning tops, and we would take a trade. All we need to do is wait for price to break above that 20 moving average line, and the next resistance level is about 60 pips away. Let's look at some other pairs. Now this is the Australian dollar, and it's very interesting because we do have an inverted head and shoulder pattern on the 4-hour chart, but price has not broken the neckline yet. It did bounce off and came back down, but it's making a second attempt. Once this neckline is breached, then that confirms this inverted head and shoulder pattern. If you're not familiar with head and shoulder patterns or inverted head and shoulder patterns, then I do have a few videos on that, but I'm just gonna, what I'll do is just go over them very quickly. There was actually 2 head and shoulder patterns, inverted head and shoulder patterns, side by side. Here is a shoulder, and here's a head. Okay, now it's taking quite a long time for this to turn into a nice run up. Once this 78.25 or 78.50 area is broken and candles can close above this neckline, then we're going to have a nice run up on Australian dollar. And if you're thinking about targets, what I generally do is take my Fibonacci tool and draw it from the neckline all the way down to the head, and then these are my targets. We have 79.30, and then 81.8, and then all the way up to 83.97. But if you look at this 4-hour chart, obviously we have found a bottom down at 76.50. Price tried to come back down to that same, penetrate that 76.50 and failed. And then it created this inverted hammer. Now, I want to show you some examples of inverted hammers. This is a 4-hour chart, but you can see them. They're more powerful when you see them on larger time frames like a daily. But let's go back in history and let's see if we can find some head and shoulder patterns. on a 4-hour chart and see, here's a great head and shoulder pattern. Market was in a steady uptrend for about 2 weeks, and then we have, here's a head, and here's a one shoulder. This is a regular, this is a head and shoulder, not an inverted, so it's, we're looking for a top. So here a head, here's a shoulder, and then what do? We need a neckline, and this is our neckline. So once the neckline is breached, that's when we take a trade. The stop loss is above the shoulder here. Okay, so this is our entry. Notice the price came back up and retested the highs, but never went above the head and shoulder pattern, and then it just kept going down, okay, and continued to sell off for, you know, months at a time. And now what we have is the opposite direction. We have exactly the same thing, but it's an inverted head and shoulder pattern going the opposite direction. But once this neckline is broken, just like the neckline was broken back here, here was the neckline that was breached, that's when we take a trade. We cannot take a trade until that neckline is broken, when we have a solid candle breaking below the neckline. Okay, so now we have this neckline, and once we have a candle that closes above here, when we have a solid candle, let me make this thicker. Notice it's starting to happen. Once price a candle, notice here how we have all these wicks, so price is rejecting the neckline, but now it's getting close to the neckline, and if this candle can close above, that will be our buy signal. Here is a trade on the Euro Yen on a daily chart. This candle here is a bullish engulfing candle because it covers 1, 2 candles, and we could not take this trade. I mean, I actually jumped the gun and I got stopped out, and I should have known better, but let me just make this a little bigger. So we have a bullish engulfing candle, and the next candle came back down around 50% of this candle, and this is our entry, and I actually took this trade right there. So now I'm long on Euro Yen, but I had to wait till the market came back down on the next candle. So all day I was waiting for price to come back down at least 50%, and it did. And now it's finding support, and hopefully this will turn around and head north instead of heading south. So again, candlestick patterns, or candlesticks, very, very powerful. Here we have a piercing candle, and that's a reversal pattern, and the turnaround and went up, right? So piercing candle, stochastics oversold, and the market, after long consolidation, it finally went up. Then it retraced and then gave us this nice bullish engulfing candle, but it was overbought when this candle was formed because we had about 250 pip candle, which exceeded its daily range. So price had to come back down, find support. This is your entry, and the market should go up. Okay, so that's it for this tutorial. Please email me if you have any questions, and have a good trading week, and thanks for watching the video.